Hi guys, my name is Aurora and I'm a part of the Forex Strategies Resources team. In this video, I will show you how to make profit with the Cobra Forex System, a trend following a winning strategy based on moving averages. With this Forex system, we only trade in the direction of the trend. This is essential to the whole system. This one basic principle reduces our risk dramatically by limiting us to trades that already have the momentum of the market behind them. We use a 72 period moving average line MA as guide to tell us the direction of the current short-term trend. A 72 moving average line is simply a line which tells us the average direction of the market over the last 72 candles. In our case, the last 72 hours because each of our candle is 1 hour long. If the real price is above the 72 MA, we take it that the market is trending upwards. So we only take trades in that direction, which means we only buy. If the real price was below the 72 MA, we would take it that the market is trending downwards. So we only take short trades. We only sell the currency. We simply look at the 72 MA to determine where the bias is in the market at that moment, so as to increase our chances of trading in the same direction as the current market momentum. Remember, we're just trying to catch the trends which happen and ride along with them to make some easy profits. And the moving average line is the quickest way to establish the bias of the market. Which way is he preferring to go? So, once we've established the direction of the trend, we will be looking for a few basic things to happen which signal our reason to enter a trade. System setup. There are actually only two indicators used in the whole system, even though initially it looks like seven. The 72 period SMA is a basic moving average line which calculates and plots the average price over the last 72 candles. So for our system, it's taking the average from the previous 72 hours 3 days. The 12 period EMA is another moving average, but this time it's calculating the average over the past 12 hours or half a day. And this MA is exponential, which simply means it gives a little more weight or importance to the most recent candles over the oldest ones. The ADX is the average directional movement index, and it really complements the MA lines. This indicator in its most basic from measures the average direction up and the average direction down over a set period, in our case 14 candles of 14 hours. The indicator is used to tell us the strength of a trend. The ADX draws a line on a graph underneath our main chart. If the line is moving upwards, it means the trend is strengthening. If the line is moving downwards, it means the trend is weakening. We only trade in the direction of the trend. So, the first thing that needs to happen is for us to establish the direction of the short-term trend and then get ready to trade in that direction. The emphasis here is short-term. This is where the 72 SMA, to keep it simple from now on I'll call this the orange line, comes into play. We use the orange line to help us easily identify the direction the market is moving in over the last 3 days. If the orange line is moving upwards, it means the short-term trend is up. Conversely, If the orange line is moving downwards, it means the short-term trend is down. If the price is above the orange line, we only take long trades. If the price is below the orange line, we only take short trades. This is a strict rule which is never broken. This basic method does two very important things for us, which makes the system so much more profitable than other trend following methods. Firstly, it keeps us out of low probability trades, then reduces our number of losing trades by forcing us to only trade in the direction of the trend. Secondly, by relying on the moment that the real price crosses the orange line to signal a change in trend direction, we can get into new trends much earlier than if we were waiting for the orange line to finally change direction. With the Cobra system, we use the price crossing the MA as the earliest possible sign that the trend is changing direction, which means we can capitalize on new trends before anyone else and pick up bigger profits than everyone else. So that's all there is to the process of establishing the short-term trend direction. If the price is above the orange line, we only go long and buy the currency. If the price is below the orange line, we only go short and sell the currency. Nothing more, nothing less. Our entry signal. First of all, we need to see whether we are above or below the orange line so that we know which direction we are supposed to be trading in. For this example, we are saying that the price has moved above the orange line. Once we know which direction we are trading, we look for the moment that the price moves outside of the blue buffer zone on the side of our trade direction. The signal comes in two stages. The first part is when a candle closes outside of the blue buffer zone in the trend direction. So, if we are above the orange line, we wait for the price to close outside and above the blue buffer zone. We then wait for confirmation in the form of another candle opening and closing outside and above the blue buffer zone. You should notice that the price has moved above the orange zone, which means we are now only going to take long trades. We then get a candle which breaks out of the blue buffer zone and closes above the outside edge of the blue zone. We then wait to see a second candle which opens and closes above the blue zone. So effectively, the second candle is completely separate from the blue buffer zone. And that's our basic signal to enter the trade and ride a new trend up. I'll give you another example here to show you again to give you more clarification. You notice that the basic entry signal is always made up of two candles. The first candle has to at least close outside of the blue buffer zone. The second candle has to have the open and close of the candle outside of the blue buffer zone, and it has to be the same color as the first candle. So if you are looking at long trade buying, but both candles should be up candles and vice versa. If you are looking at going short selling, both candles should be down. If you do not get the two candles confirmed each other in that way, then there is no entry signal whatsoever. The basic idea is we are waiting for price to break out of the blue zone before we enter the market with a trade. Trade entry criteria. First candle must close outside of the both buffer zones. Second candle must open and close outside of the blue zone and must create a new high although in the direction of the trend. Second candle must not be a reversal candle. The ADX must be above 22 and moving upwards. No trades entries on Friday. First candle must close outside of both buffer zones. The second candle must open and close outside of the blue zone and must create a new high or low in the direction of the trend. So you can see from the two examples above how the second candle needs to be going in the same direction as the first candle. The second candle is basically a confirmation of the first candle. If, however, the second candle opens and closes completely outside of the blue zone, but is not the same color candle, it does not count. You can see that in the above example, the entry criteria appear to have been met as much as the first candle has closed below the orange and the blue zones, and the second candle has completely outside of both zones. The second candle is suddenly going back in the opposite direction. It is not confirming the move direction of the first candle, and so the new downtrend is not as likely to continue. The second candle going in the opposite direction is an early warning that this trade may be a false signal. The reason we have the fifth in place is to act as confirmation. We wait for the second candle to form correctly outside of the blue zone and in the same direction color as the first candle, because this confirms that the new trend is likely to continue in the same direction. It's increasing the likelihood that the trade is a good one. You can see how this process acts like a filter. When the green up candle appeared, we didn't act, and we were potentially saved from entering a bad trade which could possibly done against us. However, when the next candle appeared and closed as a down candle with a new low compared to the first candle, this acted as confirmation that the new trend was indeed heading downwards, and we had a signal to sell the currency. Second candle must not be a reversal candle. The reversal patterns I specifically means are the following. Basically, reversal candles are where the open and the close of the candle are very close together, which causes the colored body of the candle to either not exist or be very small. And the tail wick, the long line, is very long in comparison to the colored body. This simple filter will keep you out of a lot of false signal. The ADX must be above 22 and moving upwards. When the average line is below the 22 dotted line, it means there is no trend. When the average line is above the 40 dotted line, it means there is an extreme trend. When the average line is moving upwards, the trend is gaining strength. When the average line is moving downwards, the trend is losing strength. Exit strategy. The exit is simply signaled when the price crosses and closes on the other side of the blue zone. So suppose you are in a short trade following the trend down. You would close out of the trade when the price crosses back up through the upper dotted blue line. In the example above, you can see that we stay with the trade and ride it down until it appears the trend is turning against us and about to move back up. The price has crossed back over the blue zone and looks like it is about to continue up. In this example, you can see the price does actually continue down after we have closed out. and that's not a problem. You can see immediately after closing out, we get another perfect entry signal and could have reopened a trade in the same direction and followed it on down for even more profits. It is another example, but this time on a trade following the trend upwards. Stop loss. The stop loss is put in place, as the name suggests, to stop our losses. Never ever trade without using a stop loss. As with the Cobra system, my stop losses are placed using price and the blue moving average zone. It's very simple. Wherever I enter a trade, I draw a straight line back to the blue zone and place my stop at the upside dotted blue line. Trade examples. You can see in this example how the ADX helps filter out a bad trade which would have made us lots money if we'd gone ahead and entered best purely on the candlestick. The ADX was telling us the trend was weakening and was unlikely to last, so this simple filter saved us from a bad trade. This example illustrates the reversal candle filter. You can see this time that everything was looking good for a short trade sell. The price had broken below both the orange and the blue zones. We had a second candle closing completely outside of both zones, and the ADX was telling us the new trend was strengthening because the average line was above the 22 line and was starting to move up. But the second candle formed as a reversal candle, which was our warning sign not to take this trade. And as you can see, this simple filter saved us from a very bad trade, which would have immediately stopped us out. With this last example, we have finished the description of the Cobra trading system. Please subscribe, like, comment and share on this video.